LYFT stock has a bull case, but investors won't care until the panic selling ends. LYFT, down 63%. Investors wanted the country's two leading ride-sharing companies to go public, until they did. Lyft and Uber have been disappointments since hitting the market last year, but the smaller and faster-growing Lyft is the one that has surrendered more than half of its peak value. Lyft isn't having a problem growing its business. Revenue rose 52% in its latest quarter and 68% for all of 2019. Ride-hailing is a pretty engaging platform, particularly for younger consumers who have no interest in getting behind the wheel. The 22.9 million active riders that it had when this year started are 23% more than it had relying on its app to get around a year earlier. Average revenue per rider has also risen 23% on top of that. The bottom line is a brake pedal tap for Lyft bears, but its adjusted net loss was nearly cut in half during its latest report. Lyft is another stock that may not seem like a prime candidate to thrive during the new coronavirus-weary normal, but earlier this month it did say that it was coming off of its best week ever despite the growing concerns. The problems with Lyft stock. As a result, Lyft stock seems at least intriguing after the recent sell-off. However, there are some concerns to keep an eye on. First, the 60% decline from the IPO price doesn't on its own mean Lyft stock has become too cheap. It's evident from 2019's IPOs that there was something close to a bubble in the private markets. For instance, Uber might not be down by half from its IPO price, but it's down by more than that from the $120 billion valuation bankers floated before it went public. Early week trading in Lyft itself no doubt led Uber's initial price to come down, and that, too, proved to be too high. $33 for Lyft right now may be too cheap, but $72 last April almost certainly was too expensive. And, finally, the bottom may not be in yet. U.S. stocks suffered a steep decline on Monday, and Lyft is not the name that is going to hold up in a risk-off environment. It has long-term valuation worries and exposure to short-term disruption. So while Wall Street may be bullish, I don't expect investors will be. Thank you for your time. Goodbye.